Good evening, Jax. This is Fahad. Today is 7:10 on Sunday, April 29th. Let's get started. Usually, content like this is reserved for Jaguar Pro clients, and but today I had some extra time in my hands, so I decided to put together this video, and this will be published on homepage, and you can come back to this at any time you like and take a look at it. What I would like to do is basically take a few minutes and discuss one of the stocks that is appearing on my radar called Shake Shack. I'm sure many of you are familiar with. Last year in November 2017, we did a presentation at the Traders Expo in Las Vegas, and the entire Jaguar team was out there. And one of the nights when we were out there, we were just walking on the strip, and we passed a Shake Shack location on the strip, and it was packed with lines forming all the way out, outside of the stores and around the store. It caught my attention, but at the time I didn't pay much attention to it. Um, then last weekend, I was out with the CEO Tom Joy in Troy, Michigan. We were driving around, and we passed another Shake Shack location, which is fairly new location, and it was packed. This was in the afternoon on a Sunday, and it was packed with a long line outside. And that was last weekend. And so this last couple of days, I started to take a look at this stock. Maybe there's something here that I haven't visited this stock in a long time. It's probably worth mentioning and digging deeper into this to see if there's something here. And that's how it usually starts for me. Most of the times, it's about just being very observant of what's going around us, and then picking up my notes from management commentaries and analyst notes, and then putting my own thoughts together, and then coming up with a plan. And so here we have one of those plans. Now, Shake Shack is a modern day roadside burger stand serving a classic American menu of premium burgers, hot dogs, crinkle cut fries, shakes, frozen custards, beer, and wine. It has a very simple and high quality food at a great value, and it's a fun and lively community basically for gathering place as a gathering place with widespread appeal among the young crowd. Shake Shack operates 162 stores in 12 countries and 20 United States. 90% of these stores are company owned, which gives it a lot of flexibility in its hand. And uh, in fiscal year 2017, company opened 26 new shacks, five of which were opened in just 1 month of December 2017 alone. And that's a remarkable growth, which was for the month of December, the growth rate in the units increase was 41% year over year. Now, I went back and I looked at the transcript of earnings call in February and walked away with some very interesting points. Management presented a view that the growth plans will continue to accelerate, basically going forward from here, and it is driven by a whole bunch of different things that we're going to discuss in this video here. This is the kind of aggressive, growth-oriented management after reading this earnings report and the transcript that gets me excited about how they can easily meet and most likely beat street expectations as the time goes by in quarters ahead. The company did post a very remarkable quarter with total revenue growth of 34% beyond their own internal targets, and well above consensus view as well. So as I dive into this, you will get the sense of exactly how they went about doing this and how they were able to basically beat their own internal targets. 2017 year was also a very big year for the company for international purposes, where they opened 19 new shacks across Japan, Korea, UK, the Middle East. And then a very large licensing deal was also signed towards the end of 2017 to open 40 new shacks in Hong Kong, Macau, and Shanghai. They're targeting those three cities in China at this particular time. And I believe that it could significantly ramp higher from here. This is a test case that they're entering first time in China, just targeting those three cities towards the end of 2017. But I think it could be over long term, it could be 10 times or maybe even more the size of this initial test case if it is successful, and if they can duplicate the model that they have been able to do successfully in New York City since inception. Now, this is what a typical Shake Shack looks like. Many of you are probably familiar with. This is one of their locations in New York. I don't know if many of you have been there or not, but it's always packed like this outside and inside. Now, on February 16, market didn't really pay much attention to the earnings report when it came out, because this is where you see the earnings came out. The beat on revenues, the beat on EPS. This was actually 11th straight in the entire, since the inception of the company, since the IPO, the company has consistently beat on every target on the street. Anyways, but when this company report came out on February 16, the stock took a dip and I think it was largely a function of the overall market that was behaving at the time very badly. Remember, in early February, we had two 1,000 point sell-offs in Dow index within 1 week. So obviously, a lot of things were shaken out at that particular time. The stock took a dip, but it didn't last very long. It found support at this major volume of price support, and then basically started to gradually move higher, and it has been trending higher in a very strong uptrend ever since. Now, the thing about this is that this company has a very, very high short interest, and these shorts are getting obliterated even at a time when the overall market, from a sentiment standpoint, the S&P, the Dow, the NASDAQ, or any of the major index you look at it, for the last 3 months, the market has been very volatile in nature, and it has been arguably in some ways very beneficial to aggressive bears out there that have been bearish for a long time in certain stocks and sectors, but not here. In this particular case, those shorts are getting obliterated. The company has a very high short interest. This is a little bit slightly old picture as of early December. This came from Bloomberg Terminal, but you can see at the time the short interest was 39%. It hasn't come down since then. It has been still holding steady near 38%. Actually, that's the stock price. The short interest was 50%, I should say, at the end of December. The short interest has come down to about 36 to 38% currently. So it's down a little bit, but it's still very, very elevated. But take a look at the price action since the stock, even with a high short interest. So here's where the short interest was at the end of December, or at the beginning of December, and these shorts just got obliterated. They had a little bit of come as the stock pulled back with the market volatility, and now they're basically, the chase is on, and these shorts are basically getting taken out to the woodshed, and it's still, the short interest remains pretty high at 36%. One of the main reasons why short interest has been so high is basically this predominant view that the company will not be able to duplicate a typical fast food growth model that has been proven by other companies such as Chipotle in its early phases of growth rate, or even if you go far, far back, by McDonald's, Starbucks, and a whole bunch of other, Panera Bread, and a whole bunch of other countries that during their time have been highly, highly successful. And there's several reasons for that. Here is just a snapshot taken from a Bloomberg article that was published back in December that quotes some of the points that the bears have always made around this company. More than $420 million of short interest basically says the stock price benefits unduly from what might be called as a New York premium. As a reminder, the company started in New York City, and the company has more than 41% of its entire store count in the Northeast, predominantly in New York City. So, there's this thought out there the company will not be able to duplicate that particular successful business model from New York and duplicate it to the rest of the country. And this is where I disagree with the shorts. There's a quotation here that Bloomberg stated, from Hedge Eye guys, that basically Shake Shack opening outside its hometown are often met with buzz and long lines, but once the novelty wears off, the company will have to spend more on marketing as it struggles to boost sales, and that would compress margins. And basically the short in this particular case goes on to say that means lower stock price in the future. Well, my personal experience would be completely different from that because I have seen long lines and I've seen those long lines stay continuously long in the new markets that the company has been entering. We'll dive into those in just a little bit more. Um, and the first argument, if I take all the bearish arguments in the company together, there are three major arguments that the bears make. Let's attack all three of them one by one and see where Jaguar bull case stands and see if it actually makes sense. The first bearish argument that is the predominant argument on the street is that in the fourth quarter, Shake Shack posted only a 0.8% increase in same store sales. And the trend has been decelerating for the last several quarters. And so this is very low. This is not what you want to see from a high growth companies. Low single digit same store sales growth. In fact, even negative same sales growth in certain quarters, in some quarters in 2017. And so that's one of the most predominant bearish arguments around the company. The issue with that is that the management tried to quantify, management in its earnings call on February 16, when I read the transcript, tried to suggest that basically this metric is skewed by its heavy presence in New York City. They believe that this metric will continue to show a degree of volatility because 43% or nearly half of all US-based operator stores are located in the Northeast region, including New York City. There's too much geographical concentration at the moment. Hence, significant volatility in comp sales growth. The same shack sales continue to be influenced by changes from a very small number of shacks. For example, there was one store, there were a few stores that were basically part of this plan that was passed by New York City about free WeWork, which allowed, which basically caused some of these stores to basically have volatility in the traffic trends and the same store sales, and they basically skewed the entire company's performance. So I think outside of those things, it skews the numbers, and that's why the volatility in New York City, because, for example, just a weather storm, passing through New York City could potentially create the volatility, and I don't believe that's reflective of the entire performance of the company as it expands, eventually coast to coast from a regional player at this particular time. Here is a great example of how the company is basically expanding. So you can see that 43% of the business is in New York City, and these are the stores that were just open, just going into year end. So from Dallas to California to Michigan to Wisconsin, Missouri, and that's how the mix of stores are changing. And I believe as that mix of a store changes, the volatility that we see quarter after quarter in the same store sales growth trends will start to normalize, and eventually a better picture will emerge. Another thing that I will point out is that here is a great, basically in big picture, what's going on with the same store sales growth. As you can see, the company came at a very, very high valuation when the IPO happened. And since then, these are annual bars. These are the annual bars. And so 2015, same store sales growth was hitting as high as 13, 14%. And since then, it has gradually declined. In fact, if you take the 2017 data, this is the annual bar, and you break it out into 4 quarters, the first 3 quarters of 2017 was slightly negative, and then it rebounded sharply in the 4th quarter. So the trend is improving in the last 4 quarters, but this chart does not do justice to that, in my view. For example, to see what the trend has been, again, going back to this chart, if you take the 2017 and you break it out, the first quarter same store sales growth in 2017 was minus 2.5%. Then it improved to minus 1.8% in the second quarter, improved again to minus 1.6% in the third quarter, and then it finally turned positive in the fourth quarter to 0.8%. So throughout 2017, the growth trend actually has been improving in 2017. And the management came out with pretty bullish comments for the 2018 and the future outlook. Another way of looking at it is that this is the unit growth that Shack has been basically performing. You will notice in the blue bars, these are the company-based stores, and you will see there was a huge spike. The growth rate has been consistently strong, but there was a much more significant spike in the fourth quarter where a lot of new company stores were open. Even as these company more and more stores have come online, the same store sales growth has been able to go from deep negative to slightly turning positive into fourth quarter. And I believe this is a change in character in the stock, and I think it bodes positively for the growth outlook going forward. Here's another way of looking at it. In the earnings report, management guided 2018, 2019, and all the way out to 2020 targets, which basically calls for total store count increasing from currently 160 stores to 360 stores, and that's both international as well as U.S. domestic. When you put it all together into the picture, that implies that forward guidance basically implies that the revenue growth that has gradually the growth rate has trended down from as high as 60% in 2015 and basically it came as low as 25% year over year, is basically going to start to rebound from here, and we may see this tick higher, well above 30%. In fact, fourth quarter 2017 revenue growth was well above 30%. So they're actually already ahead of those expectations if you compare to the growth outlook that was provided in this particular quarter. I dove deep into the earnings transcript because one of the things I like to do is basically try to see what kind of commentaries are coming out from the management and how they compare to the street expectations, and try to find the delta, the disconnects between both of them, because that's where the biggest surprises, positive and negative surprises, come from the market and from the stock. One of the things I found out, because I wanted to find out exactly what was it that caused a spike, the improvement in the fourth quarter same store sales growth. So digging further into it, I found that one of the main reasons was basically the fact that there was a big push into digital as well as delivery business and delivery feature that they started. So I have some few talking points that I think that are worth mentioning over here. So here is Tara Kamanti, the CFO of the company, in February 16, stating, "We were encouraged by the learning from each of the pilots, and we do believe we saw some uplift in sales as a result." Just to be clear, there was a delivery pilot program that is started in September, and then it was rolled out more and more as the year was coming to end. That's what sparked the interest and that's what basically turned the same store sales positive, as well as improvement in ticket pricing by 2.1% going into year end. There was a question that was asked by Andrew Charles from Cowen. Basically the question goes, obviously you spoke very favorably and encouraged by the delivery pilots. How are you guys thinking about it, and what are you looking for before you would more maturely roll out the delivery service? To which the Randy Garuti, the CEO, responded, "In addition to launching and learning through the app, we entered into a number of integrated pilots with key delivery service partners throughout 2017. And last 4 months of the year, we conducted pilots with Postmates, DoorDash, and Caviar as we further explore guest demand." And then it goes on to say, "So what did we learn? Turns out people really want their food delivered. So that's great." So based on these comments, as they basically formed these delivery partnerships going into year end, that's exactly what had the positive impact on improving same-store sales growth. And they believe they're going to continue to pursue and push forward into this. Similarly, another question was asked by Andrew Barish in the earnings call from Jefferies, as well as John Ivanko from JP Morgan, asking also about the delivery service. And they said, the CFO and the CEO said, "The quarter really was a delivery that, in relation to anything else, that gave us a little bit of a pop." And the CEO said, "We definitely felt that they went really well in the fourth quarter, and we felt that there was really some positive sales impact from that." So here you go. This is coming straight from the CEOs and the CFOs answering to the earnings call and basically pointing out the delivery was one of the positives that came out that basically gave them the boost. And this pilot program only started in September, October. So I believe the momentum is still building for it, as it's going to be rolled out to all the stores, and eventually as they open new stores to nationwide, coast to coast, as they expand their view from here. Another thing that I will point out is that one of the biggest bearish argument, the second bearish argument. So the first one was same store sales growth, and obviously all this data that we just showed basically goes against that. The second biggest bearish argument that's always been out on the street is that the margins are not improving, and that's mainly because labor wage pressures are continuing to weigh on the sector. Here's a snapshot that basically clearly shows what that means. As you can see, while the total revenues grew by 31.6%, 31.2% in the fourth quarter, the operating profits only increased by 30.3%, and the EBITDA was increased by 30.7%. So slightly less than the pace of growth that we're seeing on top line revenues. And I think that is a function of margins gradually coming down. This is because labor pressures are indeed rising. There is no question about this. So I think there is some legitimacy to that argument. But the simple fact is also that, you know, we can't look at this and this specifically just point out against Shake Shack. That's the only one that will be hurt by that space. It's happening across, you know, we are in full employment economy. We have very low, you know, we have weekly jobless claims and all the macro data that we look at. This is a function of the current state of the market that we're in, the current state in the late stages of the economy that we're currently in. Labor pressures do come at this particular time, and it will be felt by many companies. But I don't think we can take that view and unnecessarily, you know, use that argument to basically for disadvantage or to make a certain bear case on one or two companies. I think it speaks broadly for the entire market and many consumer discretionary stocks. And lastly, I think it's simply the function of the strong economy we're in, rather than just trying to use that as a means to basically shoot against one or two stocks in particular. I would also tell you that I believe that the margins actually, even though the margins have decelerated a little bit, if you look at quarter over quarter sequentially, as well as year over year performance, in the last earnings report, the company actually still was able to beat the consensus view. So there's this argument that, yes, they have decelerated in absolute terms, but they're still well ahead of the consensus view. Here's from February 15, when the recapping the Q4 earnings outlook, and you can see yourself, the restaurant margins were 25.2% versus 24.6% estimate, and operating margins were 6.1% versus estimate of 4.1%. And the company guided that going forward, the operating margins will stay above 6% in this call as well. So there you go. That's a second bearish argument on the street, and it goes right against that. The last thing I will tell you is that one of the things that the bears always shoot against is expensive valuation. It's an expensive stock. It trades between 60 to 80 times earnings. It's very difficult to get comfortable with those kind of valuations. You know what? The thing is that it's a high growth company. The pundits will continue to point out, I mean, depending on which street estimate, whose consensus numbers you're looking at, yes, it is indeed expensive on valuation in absolute terms, trading anywhere between 60 to 8 times forward fiscal year 2018 earnings estimates. It is an expensive stock. But if you stupidly ignore other metrics and just believe PE is all that matters to drive investment decisions, that's the only way you will come up with a conclusion that it is expensive. Shack is a disruptor with innovative, high-quality offering that appeals to health-cautious, younger, trendy audience, something that is not offered by old-school fast food giants like McDonald's, Wendy's, Burger King, and the like. You're paying for growth. More than 30% year-over-year growth versus McDonald's low single-digit percentage growth. You're paying for expansion opportunity that still exists from 20 states currently to eventual coast-to-coast coverage, not like McDonald's that has already saturated the market. You're paying for market share gains, not like McDonald's, which is subject to market share losses. You're paying for pricing power. Shack can increase price of a burger by 5%, without turning the customer away. But if Wendy's or Burger King does that, it will turn people off. Shack did, by the way, in fourth quarter, increase its pricing by 2.1% and had no impact. Similarly, you're paying for better quality of food, not factory cut frozen patties of traditional fast food giants with less than 100% beef content. By the way, in case if you didn't know, if you ever order seafood sub at Subway, it's not real seafood. It is imitation crab, which is made up of mixture of different kinds of fish grounded together with added starch, sodium, and artificial flavors. It is not even crab, but it is sold as crab at Subway. Similarly, in Mickey D's, I have no idea what percentage of beef patty is actually really beef, to be honest. Um, we obviously got off the track over here, but in big picture, the point is that with Shack, you're paying for superior growth, hence superior valuation. But even with that view around PE, question is why should a company that is investing all its free cash flows back into the business to capture growth should be evaluated on PE basis anyway? Think about this for a moment. Why not on sales basis? Why not compare Shake Shack on sales basis rather than PE basis? Well, McDonald's trades at 5.7 times trailing 12-month sales, and Shack trades at 4.6 times trailing 12-month sales. McDonald's is growing top line revenues at low single digit percentage, and Shack is growing above 30% year over year. Which one is more expensive now? The answer should be very obvious, in my opinion. Now, the thing is that with all of this fundamental background in place, earnings are coming up, and this view that I'm presenting over here is not necessarily basically a reflective of anything what is going to be reporting in earnings next week. You can see right here. I believe the earnings come out on May 3rd, which will be next week. It's not a reflection of, it's not a view on what is going to be reported. We did not talk about particular channel checks and short term or anything. This is a little bit of a more longer term in nature as to the trajectory of the growth in the stock and where it's heading potentially from here. You know, the company guided $700 million in sales as a 2020 target. If the company commands the same kind of valuation as we pay for McDonald's at 5 times sales, this would equate to $3.5 billion in market capitalization for the stock, Shake Shack, by 2020, which is 2 years out. The stock currently has a market cap of $1.6 billion. That would suggest the stock could potentially double from here, and it will still be trading at the same valuation where McDonald's or Wendy's or Burger King or some of the other giants are trading at this particular time. Which just brings me the case that what is this? This seems like basically whether you look at valuation or the forward growth targets, a prime opportunity basically as looking at where the company might be heading. Looking at technically from here, this is a very, very long-term chart, a very large basing formation over here, and it's basically starting to break out from here. The IPO came to the market at a very, very heavy, expensive valuation. Obviously, that deflated very quickly. Those expensive valuation did not have, 40. I remember reading an article back then that $45 million per store of something ridiculous like this. But since then, the company has opened more and more stores. The expansion story is on track. The margins are stable, and basically the traffic trends have improved. And so now, after a long consolidation, it is catching up. It is finally the fundamentals have caught up to a technical price action, in my view, and I think it can possibly go higher from here. Again, this is not a view on the short-term earnings that are going to be coming out next week. However, I do want to point out that they were speculative buyers of very short-term weekly calls. If you look at the option chain, you'll see that these May 4 expiration, they were buying for these May 4th weekly 50 strike call options on Friday. That's what that 2,800 volume represents. They started paying 60 cents and then they moved all the way up to $1.05. And there was also some regular monthly 49 strike call buying on Friday as well. Now, this could be reflection of suddenly very big spark in certain restaurant stocks recently, such as we saw Chipotle basically blasted higher recently after earnings. Similarly, after building a long technical base over here. And also, I was looking at BJS restaurant, and that reported earnings, and that stock blasted higher 13% on Friday. So I think some of these restaurant earnings may have sparked some interest in upside call buying and going into earnings in Shack. But I do want to point out that this is not a view on the earnings. Keep in mind there's 36% short interest in this stock, and these call options, weekly call options, were rather very, very cheap. So this could all be just shorts trying to basically buy those calls as a hedge going into earnings, worried about a kind of reaction that we saw from Chipotle or BJRI and some of the other consumer discretionary stocks that we have seen recently. So that rests my bull case over here. Let's see how the stock performs in quarters to come. But I think if you have a view out of more than 1 to 2 years, I think this stock can do quite well. All right. Thank you very much for joining. We'll see you later.